There we And for my name is Gina Weibel, and I'm going to be talking about basics about multifamily investing. So we're not going to go super deep into how to underwrite or how to make an offer or how to connect with brokers or any of those things, but we're just going to kind of cover the whole what is the big picture of what investing in real estate, commercial multifamily real estate is all about. And just to be clear, I am not a coach. I don't have anything to sell. I'm just a person who does this and I'm sharing my knowledge for free. And I do have active deals that I'm raising on. So after this meeting, people who are interested in getting involved with me, we can connect and we can talk about those. But that's not the focus of today very much. At the end of the call today, I'll walk you through some pitch decks from some old deals so that you can see what pitch decks look like and you can know what you're going through. And there were some people who RSVP'd for the meeting who are already in multifamily investing. I was hoping they would show up because then I could have them chime in and cover the gaps if I forget to talk about something or forget to mention something, but I don't see them here yet. Nevertheless, maybe they'll show up. And I'm pointing this way because this is where my chat box is. Feel free to use the chat to talk with each other and connect with each other throughout the call. And if you see someone in this call that you want to be friends with or that you want to collaborate with, then more power to you. This is a great way to meet other people and find people that you could potentially partner with. So one of the biggest questions that people ask me is how I found I've done 4 multifamily deals and people say, how did you find the people to work with? And the answer, I'm doing this answer kind of first, is that I met one of them, the first one, through a multifamily mentorship that I joined. And then the other 3 people I just met by attending places where people were doing real estate investing, talking to people, finding out what they were doing. And when I found out they had a multifamily team, I told them what I could offer to be part of the team, and they brought me on the team. So always talking to people who are getting started in multifamily and find out, I'll talk in a second about what the different parts of the team are. And if you're hoping to be a general partner, learn one of the skills that is needed, and then you can present yourself to people and say, I can fill this niche, or more than one niche even. And then they'll bring you onto their team. So, well, maybe we should talk about that first. Let's first talk about why people like multifamily and what the different designations are. So first, if you're buying a building that has up to 6 units, that's usually, that's still multifamily, but it's very small with only 6 total units. And when you have that small number of units, the type of loan that you're going to get is usually a recourse loan. A recourse loan for like a duplex or a triplex or a sixplex is backed by the individual buying it. So they look at the individual's credit score, they look at your employment history, your repayment history on previous loans. And most of the time when we're getting into doing multifamily with teams, nobody wants to be at risk of having a recourse loan. So we're trying to go bigger so that we can get the non-recourse loans. With a recourse loan, if the property is underwater and it goes into foreclosure, they're going to come after me personally. And I don't want to be in that situation. With a non-recourse loan, even if,
Okay.
oh, someone has a question, or, oh, turn off your microphone if you don't want to talk. Or do you have a question? Okay, there we go. It sounded like a child, so I was guessing it wasn't a question about multifamily, but it was probably a valid question. Okay, so with a non-recourse loan, that is going to happen for larger properties. We're usually looking for like 50 units. Well, anything larger than those like really small multifamilies, but in a non-recourse loan, it's going to be backed by the asset itself. So the net worth of the right. If problems happen, the property will get taken by the bank. They won't come attack the individual. But in order to have someone on your general partner team sign for that loan, this is the hardest person I think to find. A key principal on your team needs to have a net worth that is larger than the total loan amount, we usually take out a loan that's like 11, $15 million. So I need an individual who can sign for this, who has enough net worth to sign for this. Also, they need to be liquid enough to cover 6 to 9 months of the principal and the insurance. Also, they need to have enough experience that the bank is going to let them sign. And if you need to, you could get two people to be this partner on your team. The way they look at your experience is your SREO, your schedule of real estate owned. So this principal is going to give the bank a schedule of all the property they own and what they did to be involved in doing those projects. So since we're talking about teams, the first person that you need on the team is this key partner who's going to sign on the non-recourse loan. And I think that's the hardest partner to find, because I'm going to describe the other partners and they all have skills that they bring. But if none of us can sign on a loan to get the majority of the purchase price, then we're going to be a little bit in tight water. So I recommend to my friends who are getting started in multifamily investing to find that key principal first, or find a team that already has that person. And then you ask that person, where are you willing to invest? What types of property are you willing to invest in? And then all of the other team members go out and find that property. I've had friends who've gone out and found a property and it was a good property and they saw the value in it and they saw the possibilities, but then they couldn't get a principal to join their team who would sign on the loan, and then they ended up losing the contract. So that's why if you're at the very beginning, make sure you have someone who tells you what they want to invest in, build your team around that person, and then go find properties that you know they're going to like. So that's one of my biggest pieces of advice. Okay, I got a little sidetracked because I was talking about teams because I was thinking about teams so much. But let's go back to talking about why in the first place do people want to invest in multifamily. Most of us in here are doing a little bit of real estate. If you find a good deal on a single family house and then you fix it up and then you turn around to sell it, the price that you're going to sell it is based on what the neighboring similar houses have sold for. And if one of your neighbors lost their job or changed jobs and they were under a lot of pressure and they had to sell, they might have sold their house for less than they should have just because they needed to get out of town. Unfortunately, everybody's going to look at the comps and they'll say, well, your neighbor sold his house for a pretty low price, so we expect you to do it too. And you're like, I don't want to have to follow that, but he did that. So sometimes comps can be frustrating with single family houses. In commercial real estate, there's a little bit of comping with neighboring properties, but there's another way that properties are usually determined for value, and that is by looking at the net operating income of a property. So regardless of a lot of the other details about the property, what is the net operating income? And then you divide by the market cap rate, and that just tells you, boom, this is what the value of the property should be. So there's a lot less influence that your neighbors can have on you if your property really can cash flow at a certain rate. So one thing we like to do with multifamily is buy a property, an apartment building or something that has 50 units or something, and then we're going to find a way to make it cash flow more. So obviously, one way to make it cash flow more is to improve the quality of the units, which is similar to doing a flip. And you don't have to vacate the whole building. You'll take whatever units are currently vacant and you'll fix those up nicer. And then you'll allow current tenants to move into those units, which creates more vacant units, and you move into those. And it's kind of a game you play. There's a few different strategies for how you can slowly move people so that you always have some renovations going on until eventually everything is a little bit renovated. And as they move from one unit to a nicer unit, you raise the price. And so after a few years, when the property is stabilized, the entire building is making a higher net operating income. Divide by the market cap rate. Now you know the new value of the building, and then you can turn around and sell it. So this is pretty straightforward to calculate. You do look at neighboring buildings and you're like, an apartment this size with this quality should rent at what rate? And you're going to make yours look like that. So there is still some comping going on. Other ways, we call this forced appreciation because you're forcing the value of the building to go up. There are a list of 40 different things you can do to a building to increase the net operating income. Making the apartment nice and raising the rent is just the most common one and the obvious one. But you could also add paid parking or add covered parking that you paid for, or, specialty parking that you pay for. You can add storage lockers that people pay for. You can charge for pet rent. And you could add a trash service where you go around and pick up people's trash from right outside their door and have people pay for that. You can make an agreement with a company that does internet or wireless services, and they have a right to sell to your customers in your building. So even though you're not the one managing these television and wireless services, people who live in your building have to use that vendor. And for that right, the vendor will pay you a kickback. So you'll get several $100s a month from the vendor, if that makes sense. With your electricity and your heat, you can lower your costs, which is another way to increase your income, by having each unit regulated so that each person has to pay for what they use. And that way you end up not having to pay any overages. And people tend to be a little more careful with how much heat and electricity they use when they know that they're being measured and that they're being charged for exactly as much as they use. So everybody's expense goes down a little bit. You can add bike lockers. You can, in some places, have like a boat launch or boat lockers, things like that. Even if you improve the exterior and you have a dog run and you have a playground, you can charge a little bit more rent because there are more amenities. If you add a gym, if you add a laundry room, you can charge more rent because there's more amenities. Or you could add a gym and charge separately for that. On the laundry room, you could have this be a side business for you where you put in laundry units and you make money off the laundry units, or you can outsource and have another vendor run their laundry business, but then they pay you every month for the privilege of using that space. So even though you're not running the laundry business, you're still making money every month by having it there. So there's a long list of things you can do to force appreciation and increase the value. So when we come in and look at apartment buildings, we think, what can we do to make this more profitable? And if we can see some of those things, then we're calculating what will the future net operating income be. Is it something that we can make profit on? Okay. Okay, so let me go around sponsors. Back to the team. I'm circling back around to the team. When you have the sponsor of your team, that person who signs on the loan, if it's your team's first time doing a deal together and that sponsor is going to sign on the loan for you and he's going to oversee everything you do to make sure that it works out, and he's going to babysit your team basically, even if he's not doing any hands-on work, be prepared that he's going to expect 50% equity of the general partner share in the first deal. And then maybe for the second time, it would go down to like 30%. And for the third time, it might go down to 25%. And then after that, you probably won't need a sponsor anymore. You'll probably be able to do it yourself. Okay, so I'll go back now and talk about the team again. So the sponsor is the first person we talked about signing on the loan. I am jumping around and I apologize, but the first person signing on the loan, that's your sponsor or your key principal. Then you have someone on the team who finds the deal and sources the deal and does the underwriting. They get all the information from the seller about the rent rolls, the expenses, and there are different gurus out there who have spreadsheets that you can get copies of, and you fill in the numbers of how much does each of these important key points cost, and you fill it all in, and how much income do we have coming in, you fill it in. You'll want to look at all the leases to see what the leases say and how much they're charging, and look at all the current rent rolls, how many apartments are full, how much vacancy, how much are they charging for each one, and then in your mind you're thinking, what could we charge in the future? So underwriting is Mix's favorite. Very good. So one person on the team, at least, It's good to have multiple people check each other, but one person is out there underwriting many, many deals until they find something that they're like, okay, this one actually makes sense. This one actually has room for improvement or room to meet what we're looking for. And they bring it to the team. Could be the same person, could be another person who goes and negotiates with the seller. And we start this by submitting an LOI, a letter of intent, saying that we have interest in your building and we intend to buy it. After submitting the letter of intent, you still have plenty of time to actually go in person and do your inspections and get more in-depth records on everything to continue to underwrite. But you need someone on your team who is prepared to comb through all of that. And then you'll need someone on your team who's going to talk to banks and broker loans. We do have our sponsor who's willing to sign on the loan, but you want to find someone who's going to cover a big loan to help purchase this thing. And then there's going to be someone on your team who is an asset manager. And it might be the same people or overlapping roles here, but the asset manager is the person who's going to actually keep the business running, and they're going to need to be checking on the asset on a weekly basis. So that means talking to the property manager. The asset manager doesn't have to be the property manager, but they have to hire one, or they have to keep using the one that's already in place if our analysis shows that they're doing a good job and we want to keep them in place. So the property manager will be filling vacant units and advertising our apartment and keeping things running and answering maintenance requests. And you should have a plan in place. So the asset manager oversees the property manager and talks to them every week to see what new vacancies do we have, how are we doing at filling the ones that need to be filled. And then the asset manager also needs to stay in contact with the different contractors that we have coming in to update the different units. So it's really nice if the asset manager is living nearby so that they can go in person and meet with the general contractor. I like to always have the asset manager be someone who lives nearby, but you can have a team, and part of the team can be virtual people who are combing through the rent rolls, and those asset managers who are doing a good job will know which tenants are the problem tenants, which tenants tend to be late. What are we doing on unit 14, and do we need to evict that person, and where are we in the eviction process, and did we get our paperwork started for the eviction on that one? And that team is the one that's like going to be involved intensely to make sure everything happens. And a lot of teams, the whole general partnership shows up to have these conversations about how the project's moving forward. Then there's a person on the team who is an investor relations manager who keeps all of your investors up to date throughout this whole process. And the most common time period for a multifamily project is 5 years. I would say 3 to 5 years is most common. Whereas in a flip, most of us know that 6 months is most common in a flip. Maybe 4 months to do the repairs and then a few months to be on the market. Sometimes it's a little longer than 6 months, but that's the most common time frame for a flip. The most common time frame for a multifamily project is 3 to 5 years. So you're going to be all together for 3 to 5 years, which is why it's important to network with people and talk to them and get to know them a little bit and make sure that you kind of like each other, because you're in this relationship for a long time, and you want to get people that are going to show up and do what they promised they were going to perform and help manage stuff. And it's a headache to get into a deal with someone who you get the deal under contract and you've bought it and we just start and then they never show up and someone else has to pick up the weight. I hope that doesn't happen, but it's something to think about. Okay, so now I talked about the general partnership team. We've got a loan that's going to cover a large part of the purchase price, but we still have part of the purchase price and we still have our rehab costs, and we need to raise some more money. Maybe we need to raise $2 million. A couple $1 million is a normal amount to raise for a project like this. So you're like, we need to raise $2 million or $4 million or $6 million to make this project happen. There's only 4 or 5 or 6 of us on the general partners team, and all of us are going to put some of our own money into this project, which is going to be risk capital. We are going to put our money in to cover doing inspections and covering costs of things that we need to get the project to the point where we can get it to closing. And the reason that's risk capital is because if we don't close on the project, we're going to lose that money. So if we put $50,000 each or $100,000 each of our money in, altogether, we've already got, close to $1 million of our money locked up in the deal. If we don't take it to closing, we're going to just lose our money. So the general partners are often expected to put some risk capital in. But we need another 2 million or 4 million to actually close on this deal. So we're going to go invite all of our friends and family and investors to invest in this. And that's why it needs to be syndicated. A syndication is like a joint venture, only it has way too many people. So Cheryl and Charity and Hardeep have all been in joint ventures with me. And we have an operating agreement, and it has a few people in it, 5 people, 6 people, 7 people. And then we stop and we're like, we don't want to have too many people in our joint venture, because in a joint venture, every single person is an active partner. In this operating agreement for our apartment building, the 5 of us that are the general partners are going to do the project. And then we're going to invite 40 or 50 people to just bring money. They're absolutely not going to do anything except bring money. And it's pretty obvious. Like, we don't make them come to meetings. Even if they did come to meetings, if they had a voice about something, we would, listen to their voice, but they wouldn't have a voting power to change really anything, because they're limited partners, but they're also limited liability partners, which means their money is not tied up in the risk. If something goes wrong and we have to sell the property, our limited liability partners get paid out first. Us who put in risk capital, who are more at risk. So when we are selling shares into our operating agreement, we are selling a security, which is like a stock is a security, for example. And so the SEC, the Security and Exchange Commission, regulates how we do this. You can't just run willy-nilly around selling securities. So all of our documents have to be written by an SEC attorney, and everything we're doing is very regulated, and we have to follow rules. Otherwise, we'll get in trouble with the SEC. So when you join a syndication, you will see documents like a private placement memorandum, a PPM. It's a document which explains what the project is, and it explains all the ways you could lose money. And it tells you in the PPM, this is not a guaranteed project. All of the PPMs say the same thing. This is not a guaranteed project. You might lose all your money. You need to be aware that, if things go wrong, you could lose, which is the same thing that happens when you buy a share of stock. So the PPM is making sure that the investors are fully aware that this isn't a loan and it's not guaranteed. It's an investment, and you have to do your risk and trust the parties, and you have to buy into thinking that this project can actually work. And then if you want to invest, go ahead. But the PPM is there to tell you you're buying a share in a company and nobody is promising the success of the company. So that's what the PPM is. And then there's the operating agreement that is the LLC that holds the property, and it will list all of the partners and how many shares they have. And there's the subscription agreement. The subscription agreement says you, Gina, yes, LLC, own 50 shares, and your purchase price was $200,000, and the subscription agreement is like how much I'm buying of that. So these are documents that you'll expect to see in a syndication that you wouldn't have seen if you'd just done a JV agreement. The SEC also regulates funds. The difference between a syndication and a fund is that in a syndication, I will show you the exact property or properties that we are buying, and I will tell you exactly what we plan to do on each one and what our procedure is going to be. And if you want to, you can even come see the property and you can look at the underwriting. We have it all. And I'm selling you on a very specific deal with a very specific property. And if you like it, then you invest in the syndication. A fund, on the other hand, is I tell you, I have done 10 syndications. We always buy in the Arizona, Phoenix metro area, and we always buy 50 to 100 units, and we always do a Class B property. And I can tell you so many details about what the property is going to be because I've got a thesis of what my fund is for, but I don't actually have the property yet. And I'm saying, I want you to trust my past history and trust me, because you maybe have worked with me, to give me money for this fund, and then I'll have the money ready and I will go get the properties according to the thesis that I told you I would do. Sometimes having a fund is very handy because when it comes time to get a good deal sometimes on these properties, the person who shows up and says, yes, I've already got the money, here's my fund, let's go, quick, they can close because they know what they want. They saw the property come along, boom, they had the money, boom, they did it. And with a fund, the fund will do a capital call. People will have committed to the fund, but that doesn't mean they have to send their money just yet. And at some point, the fund manager will do a capital call and say, I found a property, send your money now. And then people send their money and then we buy the property. But you have to have your money ready so that when I do a capital call, we can buy the thing. So I do have a fund for a different kind of project, but that fund operates. I tell people what we're buying and what we're going to do with your money, but I don't have the houses yet. I can't show you the underwriting because I haven't found them yet. So that's a little difference between funds and syndications. Nevertheless, funds and syndications both have different categories of regulations that are common. The most common is Regulation D, and under Regulation D, 506B and 506C are the most common designations. So when you do a syndication, people will usually tell you it's a 506C. And I remember that this is for accredited, because it's got a C, accredited investors only. So in a 506C with accredited, the only people that can invest are people who meet the accreditation status. So they have to have a net worth of $1 million, or if they don't want to use their net worth, if they want to use their income, they have to have an annual income of $200,000 individually, or if there's two people together, like husband and wife, $300,000 a year. And you have to get a letter from your accountant showing that not only did you get $200,000 last year, but you expect to get it again this year. And then you can be accredited, and then you can join our party. The nice thing about doing a 506C is that we are allowed to advertise to the world. So we can put out advertisements on Facebook, we can put out advertisements on TV, we can put advertisements wherever we want and tell people we have this amazing project and we'd love you to invest with us, but you can only invest if you're accredited. This is smart because the SEC figures if you're worth $1 million, you probably understand how money works and investments work and risk works. So they're not going to babysit you. They're going to let you be advertised to, and they're going to let you make a decision on what you are going to invest in. So that's 506C, and that's how you can advertise and find people to help bring money to your syndication. The other one is a 506B. B might stand for brother. You can invite your brother. You can invite your sister and your grandma and your friend. You can only invite people that you knew and had some kind of acquaintance with before you talk to them about the deal. So one of the reasons I do a lot of calls like this where we talk about different topics like setting up a solo 401k or basics of multifamily or multifamily underwriting, or I have a bunch of different topics. But one of the reasons that I do these calls is so I can get to know you and find out what you're interested in. And then in the future, I can tell you about my 506B projects, because I can't just tell you about it when we're total strangers, because you're not my brother yet. 506B. In the 506B, people do not have to be accredited. You can invite anyone, but the onus is on the general partner to make sure that the person investing understands a basic knowledge of how the whole syndication works and how much risk there is, and make sure that they have enough liquidity that the amount they're investing is not going to be a hardship for them. So if I meet one of you and you are not accredited and you want to invest $100,000, I want to check and make sure, do you have some money somewhere that can be more liquid so that if you need to fix your car and you need to move, and what if you lose your job, and what if, do you have some other money that's a little bit more liquid? Because it's not going to be easy to get your money out of a syndication until it's done. When it's done, you're going to get paid back. It's going to be great. But I don't want you to invest if you need to have some liquid money. So that is on me to talk to you. That's why I'm going to talk to you first before I tell you about my 506B project. Incidentally, I do have a 506B project and I would like to talk to you about it, but let's talk after this call. Okay. Let's go on and talk about when we buy different properties. Maybe I should pause for a second. Put over in the chat if you're like, something you said doesn't make sense or something you said was weird. Put it in the chat and I will see if I can clarify. This is pretty cool that we do have some people in here who have done plenty of syndications like Na, and he loves doing underwriting. So of course he's doing that kind of stuff. One of my goals for 2025, I'm not a super strong underwriter at this point, but I want to do 100, have a notebook and just fill my notebook with, it might be a digital notebook, of 100 properties that I underwrite. And after doing so many, then I feel that I will have a good system of spotting red flags, spotting things I like, spotting things that are deal breakers, because you don't want to spend 100 hours underwriting something that is a deal breaker. You want to be able to find out quick and throw it out. But okay, no questions so far. Let's keep going. When we are looking at properties, there are different classifications of A, B, C, or D. A Class A property is usually high end, it's brand new, it's probably in a really nice neighborhood, it's less than 10 years old, and they're already charging maximum rent on that property. People who invest, some syndications are going to build from the ground up and they're going to build a Class A property and it's going to cash flow. So that is one strategy for some syndications. Then we have Class B, where it's more like 15 to 25 years old, but it's still in an okay area, blue collar workers. Then we have Class C, maybe it's 25 years and older, and it's starting to get a little run down, but still an okay neighborhood. They have Walmart, they have Costco. Actually, Class B definitely has Costco. And then you have Class D, which I don't operate in Class D, but some people make that their project. They do not have Walmart. They do not have Walgreens. They don't have any chains because it's a very rough neighborhood. And there might be a lot of drugs and your tenants might be questionable on what their credit score is and how reliable are they going to be at paying. And you might have a lot of turnover. You might have to do a lot of evictions. So that's Class D. I and my teams like to buy properties that are in the C's or D's, and then our plan is to take it up a level. So we might have a C property and we're going to upgrade it to a B property. That's a pretty common strategy for these kind of things. When you have a B property, the nice thing is you've got a better area and you've got better tenants. It's less risk, and the appreciation continues to be strong. But the cons are that to buy it in the first place is more expensive per unit. The C class property, the good things about it are you're getting good cash flow. Like a lot of times you can make a lot of money because you're charging rent and it's like it was a pretty cheap apartment to buy. It's older, it's going to take more it's going to take more maintenance to take care of, but you can buy them cheap. So B or C, they both have kind of pros and cons. Let's keep going. Value plays. I already talked about value plays. Those are the things like raising the rents, stuff like that. Oh, another value play that I didn't mention, your property manager. If you have a property manager that's not doing a great job, you're losing money by paying them to do a job that they're not doing well. If you can replace them with a less expensive property manager that can get the job done, you can save money. I'll show you an example. I'm going to show a unit that we did where the property manager had a on-site full-time employee for way too few units. It was like 38 units. You do not need an on-site full-time employee for that few of units. So we replaced them with a much cheaper property manager who did a better job and took care of many of our different properties, and it took our costs way down. So, okay. All right. Let's see what other things I want to talk about. And then I'm going to show you a real deal. Yeah, I think I should. I'm going to show you a real deal. Oh, one thing I forgot to mention. I talked all about the GPs, but general partners and limited partners. There are common divisions of equity between those two groups. I would say the most common is like 70% of equity goes to the limited partners. They're the people who brought the money to close the deal. They own together, collectively, they own 70% of the equity in the building. And then the general partners have 30%. That's the most common structure that I see. But sometimes in a deal, you might get a 50-50 division. That's also not unheard of. Kind of depends on, can you still give good returns to your limited partners, even with a 50-50? You want to make sure that you give them enough so that they get a good return. And I'm going to show you a real old deal, and I'll talk about the numbers that there's all these different math numbers that if you haven't done a syndication, those numbers haven't come up before. But if you have done a syndication, it'll make sense. NA has an 80-20 split because they want their LPs to have a bigger part of the investment. Like I said, you have to underwrite it and figure out, what do I need to give to my LPs in order for them to feel good and want to invest? So sometimes they need a little bit more equity in order for them to be getting a sweet, sweet return, and then they'll invest with you. Okay. I'm going to show you guys this deal, Wasco Apartments. This is a project that we bought in April in Tucson, Arizona. This is a pitch deck, and if you're new to investing, if you're a GP, this is what you're going to want to create for your, I'm trying to figure out how to make my Zoom controls not block my other controls. Okay, there we go. Okay, if you're a GP, you need to make pitch decks for your projects, but if you're an investor, get used to looking at these so you know what you like. Here's a quick summary of the project, and I'll point out a few things. I'm not going to go super into detail because we only have like 10 minutes, but purchase price was about $6 million. And here's something that I loved about this project. I decided to get involved with this project because it's, for me, a very vanilla, low risk, stable project with no surprises. But that means it's not got like blow your eyes out kind of returns. But sure enough, we got this in April. Here we are almost a year later, and we are exactly on target with where we said we were going to be. It's boring, but it's doing exactly what we said. But anyway, here's some reasons why it's boring and I love it. We assumed a 3.45% fixed loan for $3.25 million, and we don't have to worry about refinancing. We don't have to worry about whatever goes on in the world with rates because we already have our loan. It's already secured and the rate's not changing. So that's one thing that made me like this deal, is that that amount of risk is gone. I don't have to worry about refinancing. And then we're going to raise from our partners close to $2 million. So let's go look down a little lower. This property was built in 73, so it's a little bit older, has 38 units, so it's not big enough to warrant having a full-time staff there. The current rent is average $1,000. We are going to raise that, but it's super high occupancy because comparative to what they're getting, it's a very good rent rate. So people were pretty happy staying there. I'll tell you a true story of what happened is once we got this under contract, the management company was there, which we already didn't like, and they were already not doing a great job because they were overcharging and all of that. They knew we were going to replace them. So once we got this under contract for like 2 months while we were in the process of closing on this, they did nothing. They didn't answer any maintenance calls. They didn't try to fill any vacancies. And so several more units went vacant between the time we started and by the time we closed. And we weren't heartbroken because since those units were vacant, we could clean them up, and we did some very small repairs and like updates, but not a lot. Anyway, that's that's something that happens when they know that the apartment's getting sold. The property manager might fall down on doing their duties. So this 97% dropped down to maybe 80% by the time we actually had control of the property. But now it's back up to 100%. All of our units are full now. So we took care of it. But let's go on real quick. 38 units. It was already renovated. This is the thing. This property was renovated kind of during COVID times. So the units were nice, they were newish. And the owner was a gentleman who he was just quite elderly and his wife wasn't doing well. And he's like, I'm ready to just sell and be done. He was selling off assets and moving on with his life. And so he was happy to give us, a really good price and just kind of get out. He had improved these apartments, but he didn't raise the rents to ride the wave that happened when rents went up. I'll get back to these equity classes in just a second. But conservative underwriting is one thing that I like about the person that I'm working with on this project. He likes to be sure he can do what he promises. And when choosing who to work with, try to feel out if the person is being conservative or if they're being dramatic. And the team that I'm working with on this project, Danny is the sponsor, and he has done 6 in this area. So he has a good pulse on what's going on in the area and he knows what to expect. The reason that I'm talking so much about the area and things like that, I didn't talk about that previously, but when choosing what building to buy, the surrounding market is just as important as the quality of the individual building, because you need to know that the apartment building's in a place where people want to rent so that you're going to be able to fill it. And you need to know that there's jobs coming in and there's population moving in. So you want to do market research, and that's like a whole topic on its own, is how to do market research to determine which areas are good areas to buy an apartment building. But Danny knows this area very well, and it's a very steady area in Phoenix where we have plenty of people needing apartment homes. So he felt confident that we could fill it, and we did. So I'm feeling good about that. Here's pictures of how nice it looks because it was already renovated by the previous owner. And what he did is he took out the laundry room, which was really old, and he replaced it with a nice gym. And then he put washers and dryers into each apartment. So when he renovated, now people are willing to pay more because they have an apartment with an in-apartment washer dryer. And then we also we're going to raise the rent. We're like, you have this nice apartment that was renovated. You are paying way too little for it. We're going to raise your rent as soon as we take it over. And we have been. Second, the management that was there was overcharging us. So as soon as we came in, we replaced with different management. And then we did improve the curb appeal. There's a dog park area that we made nice. We've made signs out front and some shrubbery and stuff to make it nice. So that part of it was that we wanted people to see, oh, there's a new owner. Look at how different things are. We got this new owner and now the dog park's nice. We got a new owner and now there's lights and there's motion sensors and there's a clean walkway and there's a nice big sign. So curb appeal does matter, and it shows people that you care, but then you also have a property manager who answers the calls for maintenance. So we have put all those things in place. That's part of our plan. Okay, I'm going to skip ahead because we only have a couple minutes, but oftentimes, this doesn't always happen, but a lot of times there will be different classes for investing. If you want to be a limited partner and you want to invest, we will often bribe you to invest more. In this case, if you invest $50,000, we're going to give you equity, and your equity gets paid first. That's why it's preferred, but it's going to be lower. You're going to get 6% when we sell the property, and you're going to get 6% a year in your payout, but there's no option to go higher. That's it. So your return is going to be 12%. There's no additional. Don't plan to get more, but we're going to pretty much pay you first and make sure that you get your 12%. That's not an amazing return. So that's why I tell people don't do that class. The next class, if you invest at least $75,000, now we're going to pay you 8% preferred return. Remember, the first group was getting 6% a year. You're going to get 8% a year in cash flow, and that's usually paid out quarterly. And then if we are having a really good year and the cash coming in is even higher, we're going to split the extra cash. Like, everybody's been paid their 8%. Those people have already been paid their 6%, but we still have extra money and we need to distribute it. Okay. We're going to distribute the extra money by giving 70% of it to you guys, and 30% of the extra money will go to the general partners. Well, what if we get all the way to a certain good return and we still have more money? Well, then we'll distribute it even more. We're still going to give 60% of that extra money to you guys, and 40% of the extra money will go to the GPs. This kind of encourages the GPs to do a great job. Like, if you can make the property earn a lot of money, you might actually get some cash flow, general partners. Whereas oftentimes the general partners have to wait till the very end to get paid anything. If we can bribe you to invest $500,000, then we're going to pay you 9% cash flow every year. And if we pay you 9% and we pay that guy 8%, and we pay that guy 6%, and we still have more money to distribute, we're going to give these guys, we're going to divide it 80-20 split. So they get a higher amount, and it never goes down. That's it. So any extra money that comes beyond that is always going to be 80% for them. So this is kind of, you'll see this. This is us trying to raise money to close, and it would help us out a lot if you could bring a lot of money. So if you can bring a lot of money, we will bribe you and make it a little bit better. And right, the pref, you'll hear the word pref, or preferred return, means that those get paid first before any other stuff. Obviously, we pay off our mortgage first, but I'm talking about income. These guys' income gets paid first before any other divisions. So I always like seeing a chart like this. Maybe this will be one of the last pages I show. I always like seeing a chart like this with every project I look at. This is, if I invested $100,000, tell me the story of what's going to happen with my money. So here's what's going to happen with your money in year one. I don't know why it says that. 916 down there. In year one, you put your $100,000 in, and I can't remember why. Why are we paying you $1,000? I don't know. Oh, that's from rent. There's not going to be a lot of rent in the first year because we're busy stabilizing the property, but there will be a tiny bit of rent maybe in the third or fourth quarter after all the apartments have been fixed a little. We've started to get cash flow. We're turning a corner. We can make a distribution and give you something. And then it's just going to improve year by year. So in the next year, the cash flow from the rents are going to be higher, and your total return is going to be higher. And it's just going to keep building and building and building and building. Eventually, we may sell on this property, we may sell it anytime between year 5 and 7. We're leaving ourselves a little wiggle room so that we can look at the market and see when it's advantageous. And if we find a way at year 5 to sell it for a smoking hot deal, we will. But if it takes until year 7, we'll do it at year 7. Eventually, when we sell it, we will have a return of your capital to you. Boop. And then you'll also get, because the equity that you had increased in value by appreciation, you will also get some income from your appreciation. Boop. And so in that year, we're going to give you quite a lot of money because you'll get your returned capital. That's not taxable, but then you will get income from the appreciation, and you will also get income from cash flow. Boop. So if you add up all the money that you got back over this period of time, your 100,000 has now turned into 247,000. So this is a number that I like to look at. How long will it take for me to double my money? In this case, in 7 years, you can 2.5 your money. I like it when in 5 years, you can 2x your money. So this is pretty much on track. In 5 years, you could 2x your money. And then cash on cash is a number that just means 1 year at a time. So how much money do you have tied up in the deal? You have $100,000 tied up in the deal. So based on that $100,000 in this year, you only got a 1% return. And then in this year, you got a 3.5% return. So that's why your cash on cash was 3.5%. And then in this year, your percentage got higher and higher and higher and higher. On average, your average cash on cash was 7.5. And I would say an 8% isn't really average normal amount to expect in multifamily. When I'm looking at deals, I like to see 2x in 5 years, 8% average cash on cash, And then I like to see an internal rate of return 15 to 20%. So this one's kind of at the lower end of what I like because I like 15 to 20. But the reason that I chose this project is because it was super safe, super low risk. We're not doing any construction. We have an amazing loan. We have an operator that's very experienced. For me, I'm like, I know that it's not a super high number, but I also feel very, very safe that we're actually going to hit that number. So we've already been doing it for a year and we already are hitting all of our numbers. So I was right. This just shows that it's a Class B property. I'm going to talk about IRR real quick. When we bought it, we did comps to see if we were getting it at a good deal. We were. Our rents were a good deal. Okay, I'm going to stop sharing real quick and I'll talk about the IRR and then I'll take questions. So internal rate of return. Do I have anyone here who doesn't already know internal rate of return? Because I need a volunteer to tell me everybody already knows internal rate of return. Maybe I could pick on Charity or Cheryl because they're my friends. I mean, hopefully we're all friends here. I don't. Okay, Charity, unmute yourself.
Okay.
You'll be I need a student to teach. Okay, Charity, I'm going to explain to you two different investments, and all you have to do is tell me which one's better. Okay.
Okay.
In both investments, you're going to put in $100,000, and at the end of 5 years, it's going to be worth $200,000. So those things are the same.
Okay.
In both investments, because you started with 100 and you ended with 200, that means you made $100,000 and it took 5 years. So the average annual return, or AAR, was 20% a year. Do you agree?
20% a year?
Yeah, because every year, I didn't tell you how it was
Oh,
distributed,
I
but you
get
made
it.
essentially $20,000 a year after
Yes.
5 years.
Yeah,
Voila,
that,
you made an extra one. Okay, now we're going to get into the differences. So far, everything's true. Start with 100, end with 200.
okay.
Average annual return, or AAR, on both deals was 20%. Okay, in the first deal, I'm going to pay you $20,000 every year. And so that's how you're going to get your money. In the second deal, I'm not going to pay you anything until the very end, and then I'll give you the full 100. So now is your question. Which one would you rather do? The first one, 20,000 every year, or the second one, nothing until the end?
Oh my gosh. I really don't know. So I'm gonna guess the first one, 20,000 every year. I don't know if that's right.
Yes, good. Well, your intuition was right. So the internal rate of return is a number that tells you not just like the average annual return on both of those was the same, 20%, but you can tell that the first one is a better deal because if you get $20,000 in year one, you can go invest it in something else. You're like,
Right.
give me my money now
Yeah.
because
I
money
was
today,
back, I can do something else with it.
yeah, money today is more valuable than money in 5 years.
Okay.
Everybody can just tell that. So the internal rate of return devalues money that you have to wait for. That's
Okay.
basically what the math equation does. So the internal rate of return of that first deal is pretty close to 20%. It's actually like 19% or something. It's a little lower than 20%. The internal rate of return on that second deal is more like 14 or 15%.
Mm,
So you're
mm.
like, wow, the internal rate of return on the second deal is a lot lower. Even though the average annual return was 20%, the internal rate was much lower because you have to wait for your money. If we did a deal where you gave me $100,000 in year one, if I gave you 80,000 and then I gave you like 2,000 every year, and then at year 10 I gave you whatever was remaining, 5,000 or something, 10,000. That one could have an internal rate of return of like 30%, higher than the average annual return because you got so much money back right at the beginning. We can assume that you're going to go invest that in something else.
Hmm.
So
Yeah.
when I look at deals, I like to see an internal rate of return between 15 and 20%. And it doesn't mean you're going to get exactly the same amount every year. It's going to be all scattered. Usually you start with getting low returns and then your returns grow because the project has stabilized. So after this 1 hour, it's been an hour, I need to stop. After this hour, now hopefully you have kind of a picture of why people are doing multifamily. There's a lot of money to be made with if you're going to flip 100 little single family properties, sometimes it takes less effort to just get one apartment building and do each door, and you make more money. Also, when you're owning apartment buildings, I didn't talk about this, but to buy one building and to have one renter in it, maybe you could get a 1% cash on cash return for that investment. But if you bought a building that had four families in it, the building doesn't cost four times more than a single family. Maybe it costs two times more, but you have four incomes coming in. So now your return is scaling and you're making more based on how much you invested. And then if you buy a building that has eight families, it doesn't cost eight times more than a single family. Maybe it costs three times more than a single family, but you got eight families in there. Also, if one of your families moves and you have a vacancy, it doesn't kill your cash flow. It's just a percentage of your cash flow. So it balances and protects you a little bit on your investment. Okay, Kristen is on her way out. Thanks for coming, Kristen. Oh, let's do this real quick before you leave, Kristen. I'm going to put my phone number 608-44-8367. 608-424-8367. Send me a text right now if you would like to chat with me real quick, and then I will send you information on a real live 506B multifamily deal that I'm working on, and it's in an area that is growing quickly, and I'm very excited about it. So if you want to be part of a multifamily deal, I've had at least a few people who got into being a GP by first being an LP. They joined as an LP and they said, "Dear partnership team, please keep me informed. I want to learn how this is done. Sometimes invite me to meetings," things like that. So send me a text if you want to hear about the real project. And then, yeah, how about that? There's my phone number. And I would love to share with you the details about that project. Na did that. He started as an LP in his first two deals, and now GP and KP. Do you want to tell everybody your story? Unmute and come on here. That's a good story. I need to remove myself from being pinned. Are you willing to tell everybody about how you went from being an LP to a GP?
Yeah. Can you hear me?
Yes.
Okay. I was in the kitchen and my teenager was doing some stuff. So we started in multifamily back in March of 23. Didn't know anything about it at all. Attended a Grant Cardone real estate summit and learned about it. We were LPs in our first deal of 200 doors in San Antonio, Texas, then LPs with a group in Dallas for 63 doors. They saw that we were hungry and eager to learn, and we had some good skills that we could bring to the table. I love to underwrite and raise money, and my husband's really good at the construction CapEx side of things. So we became GPs on 325 doors in 133. So we're over 700 doors now, and we have a multi-pack deal under contract right now that we're closing in 3 weeks. And it's 339 doors between the two apartment complexes. So couldn't do it alone, definitely had to find a group, and we found a group that had been doing it before. So that's how we were able to become successful, is to use the skills and strategies of others and broker relationships, because multifamily is all about broker relationships. So
yeah, you have to have a team. So how did
yep.
you find the team that you first joined as a first GP?
Yeah, so we found it through at the summit that we were at the real estate summit sponsored by Grant Cardone in Miami, Florida. We met some people that happened to be here in the Dallas-Fort Worth area. So we were able to join in with them. They had already closed several deals beforehand, so we were able to kind of lean on them and their experiences that way. But it's definitely a team sport, and we could not be where we are today without what we learned from the Grant Cardone real estate program, but also the others in the group. It's the network that you develop and create.
Totally. So when you joined that first team that you were a GP on, did they
Yes.
already have a property, or did you help them underwrite to find a property?
Well, interesting. We had underwritten the property previously and we
You
hadn't
did.
done
Okay.
any deals. And so when I did the underwriting, I think I had it at like 12.7 million. And Then when the team presented it, they're like, hey, we have an LOI, we have this under contract, it's 13-1. And they gave the address and the name of the apartment complex. It was like, no way, I underwrote that like 5, 6 months ago, but we didn't know brokers. We didn't really know what we were doing. If we were to call up the broker and say, hey, my name's Natasha, I'm here in Dallas, they probably wouldn't have given us the time of day. So had already underwritten it, but didn't do anything with it just because we didn't have the team around us. So most of the other deals since then have all been from broker relationships. So the brokers that we have here in the Dallas-Fort Worth area that we've worked with before, they go ahead and they want to do business with our off-market deals with people that they know can close properties.
Yes, they do. Making relationship with brokers is a whole thing in its own. So that's nice.
Yep.
Like,
Yep.
do you agree with me that having a sponsor is the hardest thing to find? That's what I feel like is the hardest thing to find.
Well, the way that we do things is a syndication. So we were actually KPs or sponsors on the last one that we closed. It was 4 of us. It was a $13.1 million property. So we had to have enough liquidity and not just one of us had that.
Oh, so you split it amongst you. Okay, that's good.
Well, and so we were investors. I think no, all of us were GPs on the deal. But with the other ones, and that's just the group that we found, happen to have kind of KPs all within it, the key principals, or the sponsor. And then we were asked by the group if we would be willing to do so and sign on the loan, which we happily did because we're also GPs and LPs, because that is the hardest thing, a sponsor, if they're going to put their money in, if they don't have any say in what's going on. And then the percentage that we offer is a little bit less for the KPs, mostly because they're GPs as well. But I know some of the numbers, and that's the beauty of multifamily is you can structure the partnership and the deal however you want to. So it's really cool.
Yay.
Yeah.
Okay,
And Cheryl, I just saw, are you going to
Yeah.
be at the real estate summit in April in Miami? We are too, so we'll have
Yeah,
to meet in person.
yeah. I already booked my flight and hotel, so I'll be there in April. Yes, hope to see
Nice.
you there.
Yeah. Look forward to meeting you.
Yeah, same here.
Okay, anybody who would like to go through a presentation of a live deal, and it doesn't have to be today because the Super Bowl's starting in a couple hours, I know. We can send me a text and I will show you the details on a live deal. It's in Utah. Utah is really booming right now. Cheryl, oh, you want to get Natalie's number, Natasha's number.
Natasha, yeah, I put it in
Remember, it
the
started with the
chat.
NA.
I can type it again here in the chat as well. But it's all
Fantastic.
about connections, and for all of us as women.